Our last speaker is Nick Giannuzzi, and he's the founder of the Giannuzzi Group, and he's a lawyer, and he's an investor, and he gets deals done. But what he really is a counselor to brands, and he's worked with dozens of entrepreneurial brands that have taken so many steps in their progress toward growth. Now, he's here to talk a little bit about how you time these steps, when to raise, when to sell, and to look forward into the market as we all look to grow in the next year. Please welcome Nick Giannuzzi. Green, red will take you back.
Hi, everybody. My name is Nick Giannuzzi. Jeff, thank you. I want to thank the whole BevNET team for including me. I started as the kid in this industry representing vitamin water and smart water in 1999, and somehow I've blinked my eyes and I sort of become the old man. But I've had a lot of fun along the way, and this industry has been incredible to me. Most of my best friends are in the industry. Just saw Cheryl and Dwayne. I saw Bill Krillman speak from Spindrift and GT, Neil from Fordo, and all the other amazing entrepreneurs and service people in this industry. And it's just a wonderful thing to be part of. And I just want to take 1 second and express how grateful I am to be part of it. Jeff asked me to talk about timing of raises and sales, which is an important conversation. It's a little bit amorphous, and I'll try not to get stuck into silly details, and I'll try to tell you what I'm seeing in the market. That's my team. We're 15 lawyers. We're based in Manhattan in the Meatpacking District, and we're very busy opening an office here in Santa Monica as we have so many California clients. That's a little bit of some of our clients. We represent about 1,000 food and beverage companies. Some of those we've sold, some of them we're working with, and there's a bunch more young brands that we're working with now and trying to get them to the stage of some of these bigger companies. Some of our deals we've done, last year, to give you a little perspective, because we'll be talking about this, we did about 150 equity financings for our companies. We sold 16 companies. There's a couple of them here on the board of some of the deals that we did last year and this year. So when is the right time to raise money, and when is the right time to sell? Start with raising money. The first thing to say, I think, is that there's been sort of a tremendous shift over the years. In 2010, 2012, if you wanted to raise $1 million or $2 million, you were probably doing a sort of angel pass the hat type round where you were collecting from $50,000 from one person and $100,000 to another. And that there's a lot of wonderful attributes about doing those sort of angel round deals. You can do them in a convertible note form, you can do them in a common equity form, and generally when you've got a bunch of people throwing in, nobody's really asking for any sort of negative controls or board seats or those types of things. The converse is the more sophisticated investor, where in 2010 and 2012, they didn't really even exist. If you wanted to raise $1 million or $2 million, you were piecing it together a nickel at a time. And instead, what's happened in the market amongst the change in the sort of additional and increased capital that's come into our sector, when the rest of the world realized how amazing we are and how many innovative founders we have and what a great place it is to invest, one of the things that happened is you started having sophisticated investors, funds, family offices that were dedicated to our space, but they were now a choice to do the $1 million raise or the $2 million raise. On the plus side, you get very often really sophisticated people. Cheryl and Dwayne were talking. Dwayne invested at a fairly early stage. Cheryl was able to pick, a soulmate, it sounded like today. But she was able to find a really great partner who was really sophisticated and was really helpful to the business. But on the contrary side, sometimes, in addition to that, these early institutional investors are asking for a lot of controls. Cheryl has a great example of a wonderful board member. Well, what happens if you do an early round deal and you get a really disruptive or just a poor board member or someone who's a detractor or someone who doesn't add value? In addition, when you do the early rounds with sophisticated money, they're going to ask for preferred equity and they're going to ask for other rights that you otherwise wouldn't have to give away. And as I mentioned, 5 years ago when we were doing these little rounds, you were piecing them together. Now, even the $1 million rounds, the $2 million rounds, there's these new investors that are there. The other plus is that you can now find the money. I once joked and said, it's easy to raise money, and a bunch of people said to me afterwards, you got to be kidding me. I don't mean it's easy to raise money. I mean, if you've got a good product and you're a hardworking entrepreneur, the money's going to find you in our industry because we have really good information, and you can go to places like BevNet and you can communicate and you can meet people and you can find out who the good investors are. And as a result of that, there's almost not perfect information, but there's good information. When do you raise and how do you raise? I believe that for a small company, you really don't want to over-raise. If you're more conservative, you might raise enough money to get your company going for 24 months. If you're more sort of aggressive and you believe that you're going to grow a lot, well, you're going to raise a smaller amount of money in order to suffer less dilution. So you're getting a $4 million valuation. It's time to raise money. If you raise $2 million, well, that's going to be 2 out of 6, giving away a third of your business. If you only raise $1 million, well, you're going to give away 20% of your business. So what's the decision making there? The decision making is, what's the least amount of money that I can raise to get me to that higher valuation that lifts my business to sort of that next plateau? And I think that when you think about raising money and how much money to raise, you have to think about that. So I was just outside speaking to a client, and they asked, Nick, we need to raise money, and we're thinking about raising $3 million. I'm like, don't talk to me. Put together the business plan for 2019, and then let's dig into it, because then we can figure out the timing of it, how to do it, what we have to give away, what kind of valuation we can ask for. Because if you do it in any other way, you're not really going to have the input in order to come out with a good solution. And for beverages, like it or not, there's not very many beverages. We work with maybe 200 beverages. The successful ones are going to do multiple rounds of financing. Whether you're Spindrift or Rebel or any of these other ones, chances are you're going to have a lot of dilutive events. And that's okay, but you have to have a strategy on how to go about that, because as the founder, as the management team or whatever, you don't want to end up with 10% when it's all over. So you have to be smart about the timing of the money that you raise. Moving on to right time to sell. I think that this is, I'm starting to feel a bit of a change in the market. I think hopefully our economy holds out for a while, and hopefully we continue to grow. And we've had such a wonderful shift of private equity and family office money into the space. We have a lot of strategics that are no longer just waiting to buy you sort of at the end of the race. And companies like Pepsi and Coca-Cola and a bunch of the other large international food and beverage companies are coming in and investing early. And they're doing different types of structures. We're selling companies sometimes when our companies have 10 or 15 million in revenue. 3 or 4 or 5 years ago, we didn't see that. We're seeing these sort of two-step transactions. I think, though, in terms of timing of your exit, first of all, you have to take inventory of your investors, the founders, the management team. Are the founders' legs weak? Is the management team, do you want to keep going? When you take in private equity money and they're in for a year, chances are in 1 year, they don't want you to sell. It would have to be one hell of a year in order to convince a private equity fund to want to sell a year later. They normally would want a longer period of growth. So you have to factor that in. You have to sit down and you have to figure out when is the right time. Sometimes there's a real struggle there. Sometimes the founder is saying, gee whiz, if I can sell for $80 million, I'm good. The private equity fund might not get much of a return at all on that. And so as you do your deals with investors, you want to have a view towards the timing of your exit. Banging your head on the ceiling, we've had a lot of cautionary tales in the space. We've had companies that have grown and grown and grown and then gone flat. And growing and growing and growing is a great environment to sell your company, because the buyer is going to extrapolate up and assume that when Coke or Pepsi or whoever it is, DPS, whoever buys it, they're going to believe when they plug the product into their system, they're going to grow that much more. But if you've started to flatten, or you are flattened, or you're losing growth, you've waited too long. At that point, you better make one hell of a lot of money, because you're no longer looking at revenue multiples, you're looking at EBITDA multiples. And most of the brands that we work with, they're not focusing on bottom line growth, they're focusing on top line. Too big to sell, we have had some of our more successful brands get bigger and bigger and bigger, and there's less and less people to talk to about an exit. You might, when you get to, $500 million in sales, there may be no buyers left in the market. Luckily, that doesn't happen that often, because most of the brands that are that successful sell earlier. But we have seen that as you get to a certain size, there's just less potential homes for your brand. And so you don't necessarily, you want to, the expression, leave meat on the bone. You want to leave enough there so that a buyer can say, well, we'll take over the manufacturing, we'll get the brand, and we'll do the distribution, and we can get more out of this. And then finally, economic changes. I have a lot of private conversations with my clients that have gotten to that size that can start thinking about an exit, and people are concerned. There's good multiples in the market. There's a lot of buyers in the market. Is 2019 going to stay that way? Is 2020 going to stay that way? Do you work to get from 30 million in sales to 50 million in sales, but then by the time you go to sell, you're not getting a 4x, you're getting a 2x, and you wasted a year and took all that additional risk on? So those are things that you have to really contemplate and think through as you're starting to approach your sale. And I think having a good team around you of advisors can help you figure that out. And then just real quickly, there's all sorts of types of investments, whether it's strategics coming in and taking an ownership stake and not having a right to buy and not having all sorts of rights. There's sort of the two-step exit transactions. There's sort of an early sale. Chameleon was something that sold a little earlier than we usually see, and there was an earn-out component. I couldn't find any majority sales at the partner in beverage. We just closed a deal a couple months ago with Nestle and Terra Fertile, which sells beverages as well. That was a majority sale with a path towards future complete ownership. And then, of course, you have your classic 100% sale, which is still alive and well, as we saw with Core recently. But there's plenty of transactions like that as well. Jeff told me I had to leave 5 minutes for questions and answers, so I tried to speed talk.
You wanted to talk to me.
I always want to talk to you.
So, yeah, please sit here. Great presentation. Great to have you here.
Thank you.
Thank you for giving the clicker back.
Yep. Jeff also told me I looked nervous before I got up here, so I tried to take a deep breath before I started.
You did. You seemed okay.
Thanks.
You've been on the inside of a lot of deals, and one thing we keep hearing about is the value-added investor. Are any of them really value-added?
Yeah, they are. I was speaking about the difference about these early investors, and there's some, sometimes it gives me heartburn because these smaller funds come in early and they want all these rights, and I'm sort of the champion of the founder and the management team, and you have to give away some control, some negative controls. But there's a lot of investors out there that can really make a difference. There are funds out there that have a bag of tricks that make you better. and you have to do your due diligence. And the good thing about our industry is it's pretty transparent. If you're thinking of taking on an investor, ask, talk, go to the trade shows, be at BevNET, talk to people, because you can find out. Like, there's no place to hide in this industry. If you're good at what you do and you're a good person, people will find out. If you're difficult to deal with, if you're problematic, people find out. So make sure you do your homework, but sometimes the investors can make all the difference.
Where are they best able to impact a business? Where's a value-added investor best able to impact a business? I mean, are they sort of the operator model or the get your financial house in order model?
We have a lot of clients we've represented, founders who've had big exits, and then they start funds. And that type of investor has that sort of ability to complement a founder with the founder skills, the things that a founder should do, but someone who's already been through it. Other of these funds come out of different areas. Some of them are tied to, for instance, they're tied to brokerage or brokers, or they're tied to, you can have a strategic as an investor. I've seen strategics come in and dig in and fix the manufacturing facility and the supply side of a business because they're so damn good at it. Mm-hmm. And so I think, or I've seen other funds come in and they just have a long Rolodex. They can introduce you to the next investor. They can introduce you to Costco. They can introduce you to Walmart or Whole Foods or whatever. So I think now, 5 years ago, my answer would have been different. Now there's a private equity fund or a partner out there that can fix almost any weakness that a company has, that a brand has, and that a founder has.
Should companies consider taking a discount on valuation in exchange for that level of experience?
The official answer is absolutely not. They have to pay. The behind-the-scenes answer, when I'm counseling them and we're talking through it, is for the right investor. Like, getting the $10 million valuation instead of the $8 million valuation is not worth it. Getting the right partner is everything, because there's almost, I always say, I've almost never had a brand that didn't have a rainy day. You hear all these wonderful stories about these great exits and all these successes. Nobody got there in a string of sunny days. There is always problems. And when there's that problem, when it exists, the people around you matter, just like in life. And so put yourself with the people that matter. And if you have to give them a discount, so then at the end of the day, when you're standing up on the podium talking about your $200 million sale, you've got 3% less or 5% less. So what? So what?
There's an old saying that I'd rather have, 10% of a $1 billion company than 100% of a $3 million company. Is that something that first-time entrepreneurs in particular should consider?
Yeah, I mean, I would say that, again, the thing that's unique about this industry, and I started by mentioning this is not like any other industries. For the young entrepreneurs that came out of school and fell into this, you just got lucky. This is a supportive industry where there's good people here. Put the good people around you. Go into battle with the people that really will get your back, not just in the good days, but in the bad days. There's all sorts of talented people. Figure out what you need, figure out what enhancements you need, and find those people and put them on your board. Let them invest. Don't try to squeeze it and hold all of it for yourself. It's too hard to be successful. If I always think if someone's going to give me a 5% chance of success, 5% better chance of success, I'm certainly willing to give them 5%, and I'm probably willing to give them more because it's just so hard to ultimately win.
All right. Well, thank you for being one of the good people.
Thank you.
On everyone's side.
Thanks for saying that, Jeff.